Risk is what gets you fired. The concept of risk is key in financial markets, and I want to talk about this today within the context of the Stefan Wolfram model of discrete events that are transformed through time through a certain rule. And the rule in the financial markets, as we discussed in our episode yesterday, is a, a balance between expected return and risk. And we define risk as what gets you fired. And this is incredibly important. Before that, we want to give you the update as usual. So it's September 18th, 2020. This is Krimdelko. For the day, the fund is up 12.5%. For the year, the fund is up 214%. The market today was down 1%. And for the year, the market is up 4%. So we're outperforming by 211%. Risk is what gets you fired. I think risk for people in the financial markets and in the academic world and financial economists and whatnot, they're all thinking about this in many different ways. We have, of course, the concept of volatility. Daily volatility, for example, is always considered to be a risk. We have value at risk, which is used by investment banks and funds. We have correlation, we have covariance, we have lots of mathematical concepts which are trying to quantify risk. I think they're all failing because humans absolutely don't care about numbers. What humans care about is either to get promoted or not to get fired. And therefore, risk in the context of a fund manager is always either what gets you fired or the inverse, which is what gets you promoted. And this is how people actually make decisions. So nobody cares about covariance or correlation because they don't know. So that's also why risk managers often sound like kind of lunatic scientists that talk of gibberish that nobody cares about. It's not because they're stupid. Actually, they're usually very intelligent people. It's because their concepts don't matter for humans care about risk. And I just want to use a certain analogy. For example, when you're out in nature hunting, you can do a lot of statistical analysis. Similarly, like somebody in the financial markets, you can calculate the risk of this and that and catching and a thunderstorm and a flood and a fire and a tiger attacking. You can do a lot of statistics. In the end, the only thing you care about is to survive and to get food. So in a sense, the financial markets are like that. You eat what you catch and you die if you do the wrong thing. And you need to avoid to die and you need to catch to eat. And that is what risk is. So risk is what gets you fired. I find that incredibly revealing because it explains a lot of things that we often scratch our heads. For example, why are conventional investors not able to buy into Silicon Valley? Well, it's because their culture is such that if they buy something they don't understand or which is out of the ordinary, they could get fired. So they don't do it, even though the expected return relative to the risk, for example, of buying something like a Tesla or an Apple or an Amazon, it would be much, much better than buying something like GE or ExxonMobil, etc. But they still prefer to buy something like GE, ExxonMobil, because that is the context in which they are certain not to get fired. It explains many other things also. For example, why there are these incredible outsized returns that you can actually reach with stocks like Tesla, for example, because you might think that according to the efficient market hypothesis that all these things are priced. Well, they are priced, but the culture and the risk aversion and the risk taking ability of people is different. And I would say it's discrete. It's a little bit quantized. And I don't want to necessarily now develop a quantum theory of financial markets, but I would say that risk is a kind of like a quantized entity where it's not linearly fluid from investor to investor. I would say there are certain pockets, and I would say the quantized risk theory has a lot of support in reality. So there are people that take a lot of risk and there are people that take less risk, and it's all a function of what gets you fired. And what actually is quantized is not the risk aversion or risk taking ability. It is the what gets you fired thing which is quantized. So, for example, you have a lot of institutions that simply put rules on fund managers. And if you break those rules, you get fired. For example, pension fund managers, a lot of mutual fund managers, they have to follow certain rules, certain diversification, certain concentration, etc., has to be in the fund. And if you don't follow that, you get fired. Therefore, you cannot think according to the transformation rule that we developed yesterday, which is that an investor thinks about investing money in the following way. They want to invest in the highest expected return. And the constraint is not to get fired or not or risk adjusted highest expected return, which is basically what is the highest expected return I can reach without getting fired. This is really what every fund manager intuitively, explicitly or implicitly, I don't care, everybody thinks along those lines. And this explains why we have this quantized risk-taking graph, if you want, in the world where there are funds that take a certain amount of risk, and there are other funds that take a certain amount of risk, and there are these leaps, these quantum leaps, these discrete steps. It's not linear. So you have a big chunk, the trillions of dollars which are invested through pension money and savings and all that, through mutual funds. They are in a very low risk-taking category because of all the rules that they impose on themselves. And then there is another area of investors which let's call them alternative investments, which is venture capital, hedge funds, private equity. They are in a little bit of a higher risk-taking ability because they have the discretion to use more leverage. Or in the case of venture capital, they have the discretion to extend the time horizon, and therefore they have more the extension of the time horizon basically increases the probability that you hit a home run. And I have to caveat one thing, that the investment uh, strategy of venture capitalists is to have a lot of different investments. And if you put enough time and a lot of investments, you have a good chance to reach a very high return with one of those investments. So they are in a little bit of a higher risk category, but I would say it's still a very small step from the mutual. The difference between a mutual fund and a venture capitalist actually is very, very small, despite all the narrative and all the supposed geniuses in Silicon Valley, which make all these billions. If you really look at the returns and the actual inner workings of those funds, they're almost the same in terms of sophistication, in terms of risk-taking ability, in terms of the way they think about investment. It's just that because of the rules around the investments are a little bit different, therefore you perceive them as a little bit higher risk takers, which in the end they probably are. And then I would say there's a third category, which is the kinds of funds like Orange Capital Partners, which are in the business of wealth creation. So they are not money managers or wealth managers. We are wealth creators. And therefore we are the closest in the investment world you have to founders. We put all our eggs in the basket that we understand best. We align ourselves fully with the incentives of our investments, and we live or die with them. And the question, of course, is why are we able to do that and others don't? And the answer is, well, because for us, the risk to get fired is simply not to go bankrupt. That's the only constraint we have. Everything else is okay. Everything else is wild game because we defined our purpose as such to generate wealth by investing in disruptive technology with large impact. We therefore already take out all the risk of failing and all that other stuff. That is all out of the equation because we are supposed to generate wealth. So the only thing that we have as a constraint is not to go bankrupt. Other funds out there have that same type of constraint. I would say we are very few. There's very few of us out there, and that's fine. I won't mind at all to be rare, particularly in a very competitive market like the financial markets. It's incredibly useful to be a niche player in a very lucrative, very untapped part of the market. And we're very happy with that. But I want to get back to Stefan Wolfram's concept and our derivation of that concept, which is if you look at the financial markets as entities, as like let's call them the units of the financial markets, the undivisible fundamental units of financial markets, which are investors. These could be individuals or funds, defined as entities that have more money that they need to cover their costs, so therefore they have spare money to invest. The transformational rule is that you maximize the expected return through your investment. So you take your money and you invest it in something which gives you the highest expected return under the constraint that you don't get fired. If we think about the financial markets like that, I think we can explain a few fundamental questions. Number one, why are there so few people concentrating on very high return investments such as Tesla, Amazon, etc.? It's because they would get fired if they did that. So that's it, as simple as that. Another very important thing is that this whole expected return equation, of course, changes with the Fed, and this is where the Fed and the interest rate environment and the generally global macro environment comes into play. If you have zero interest rate, your expected return is zero if you don't take any risk. And a lot of people, a big chunk of the market, those types of people who are have a very, very low tolerance for risk because they might get fired very quickly if they step out of their boundaries, they are all going to live in a very low expected return environment for a long time. And because risk is quantized, and it's like in quantum physics, to get from one level, let's say the orbits of electrons, to get from one of those orbits to the other one, you need energy, right? You have the lowest orbit of energy, or the lowest the ground state, which is the lowest energy state, and the ground state is, I would say, the bulk of the market, which is the people that absolutely don't want to take any risk. Those people that are chasing a risk-free type return. All those people will sit in a zero interest rate environment. Therefore, the ground state, because of the Fed and the economy that we're in, has been reduced to an expected return of zero in nominal terms. Now, to get to a higher state, which is to get to a state where you actually can have higher expected return and therefore take a little bit more risk, you need to change the definition of what gets you fired. That means you either have to join another company that has different rules, such as our company, but more importantly, you have to change your mindset, and that's very difficult. It takes energy. It's possible, it's doable, but it takes a lot of energy. And I think there's a lot of inertia, and therefore it takes a long time. That's why there are these opportunities out there for people like us, which we went through that process a long time ago. Me and my co-founder Zovinar, we came from Wall Street and we started investing in disruptive technologies, but it took us a long time to get rid of the constraints that we put on ourselves by, let's say, we always wanted to be diversified. We wanted to look at returns that were within the normality of 20, 30% annual returns. We never thought about returns of 200-300% like we have this year. We also were always thinking about having a bit of a diversified portfolio. We were a bit scared of concentration. It took us a long time to get those shackles off us. And once you take the shackles off, you start looking at places that you've never looked before, and all of a sudden things look very different. So it took a lot of energy. We were, I would say, always in the sort of realm of survival. There were some times when we were really close of thinking that we might not be able to survive, and that we have to do things like look for other jobs or make money in a different way. But overall, we were able to navigate this process pretty well. I would say it took us a lot of energy in terms of changing our mindset, reading books, having lots of conversations, thinking about it. I mean, that kind of energy. I think now we're at a good place. We're in a safe place where we're comfortable with our risk, comfortable with our concentration. and we are also comfortable with the way we think about financial markets, which, according to uh, what I said also yesterday, is also, I have to give a big thanks to Stefan Wolfram and his physics project to help us reframe the way we think about processes such as the financial market. So to summarize, risk is what gets you fired. Risk is quantized. Most people are in a I don't want to get fired mode. And because of that, they have a very low expected returns. There is very high expected returns to be had. But for that, you also have to change the fear of getting fired, which you can do by either changing the rules in your organization and or changing your own mindset, which has to be in a way such that you can, even if you get fired, survive. So you have to lower your cost structure, or you have to be in a situation where you can sustain large drawdowns or bad reputation or being laughed at and all these kinds of things, so you can continue pursuing those high expected returns. Thank you.